Most beginners think smart money concepts are too complicated. But what if I told you that you only need one simple setup to catch high probability trades? In this video, I'll show you two real chart examples where the exact same strategy gives a clean 1 to 3 risk to reward setup. No confusing theory, just a step-by-step process that even beginners can understand and start practicing today. Let's get into it. Before looking for an entry, the first thing I do is understand the market context. I don't jump into trades just because I see a candlestick pattern. Instead, I ask myself one simple question. Where is the best place to look for a sell? Since I'm expecting a bearish move, I wait for price to trade into an important area of interest instead of chasing the market. This keeps my entries planned, patient, and much higher probability. Now that we understand the market context, the next thing I'm looking for is buy-side liquidity. This is where many traders place their buy orders or stop losses, usually above previous highs. Smart money often pushes price into these areas to collect that liquidity before reversing the market. So instead of selling immediately, I patiently wait for price to sweep this buy-side liquidity. Once that sweep happens, it tells me the market may be ready for a bearish move. And that's when I start looking for my confirmation, not my entry just yet. After the liquidity sweep, I don't enter the trade immediately. My next step is to identify a high probability point of interest, and in this example, it's this bearish order block. An order block represents the area where smart money may have placed large sell orders before the market moved down. Instead of chasing the bearish candle, I patiently wait for price to retrace back into this order block. If price respects this zone and gives me confirmation, it provides a much more controlled entry with a smaller stop loss and a better risk-to-reward ratio. Before the actual move begins, the market may create another small liquidity area, also known as an inducement. This move is designed to attract more traders into the wrong direction and encourage early sellers to enter too soon. While this step doesn't appear in every setup, it adds extra confidence when it does. That's why I treat inducement as optional confirmation, not a requirement. My main focus is still the order block and waiting for strong confirmation before entering the trade. Now comes the confirmation I'm waiting for: displacement. After price reacts from the order block, I want to see a strong bearish move with momentum. This tells me that sellers are taking control and the market is likely ready to continue lower. Without displacement, I avoid entering because the setup isn't fully confirmed. I always let the market prove its intention first, and only then do I prepare for my trade. After receiving my confirmation, I execute the sell trade without hesitation. My stop loss is placed safely above the order block to protect the trade if the setup fails. For my take profit, I target the sell-side liquidity below because that's where price is likely to be drawn. This gives me a clean 1 to 3 risk-to-reward ratio. Once the trade is placed, I simply follow my plan and let the market do the rest instead of making emotional decisions. As the trade starts moving in our favor, this is where many traders make their biggest mistakes. Some close the trade too early because they're afraid of losing profit, while others keep moving their stop loss without a valid reason. Once you've planned your entry, stop loss, and target, trust your analysis and let the trade play out. Every trade won't be a winner, and that's completely normal. Your goal isn't to win every trade, it's to follow your trading plan consistently. In the long run, consistency is what separates profitable traders from emotional traders. Now that you've seen how this setup worked on the first chart, let's see if the same process works again. Instead of memorizing one trade, the goal is to understand the logic behind it. If a strategy is truly reliable, you should be able to apply the same rules across different charts. So, let's move on to our second example and follow the exact same step-by-step process. Now we're on the second chart, and before looking for an entry, I follow the exact same process. The first thing I do is understand the market context and identify what I'm expecting from price. Since my bias is bearish, I'm not interested in selling randomly. Instead, I patiently wait for price to move into an important area where a high probability sell setup can develop. Having a clear plan before entering the market helps me avoid emotional and impulsive trades. Just like the first example, I begin by identifying the buy-side liquidity above the previous highs. I'm not looking to sell before this liquidity is taken, because smart money often uses these areas to trigger buy orders and stop losses before reversing the market. Once the sweep is complete, my attention shifts to this supply zone, which is my point of interest. In this example, there's also a small inducement before the main move, adding extra confidence to the setup. Now all I need to do is wait patiently for the market to confirm my idea before taking the trade. After price reacts from the supply zone, I wait for a strong bearish displacement, because that's my confirmation that sellers are in control. Once that confirmation is in place, I execute the sell trade according to my plan. My stop loss is placed safely above the supply zone, while my take profit is set at the sell-side liquidity below, giving me a clean 1-to-3 risk-to-reward ratio. At this stage, the setup is complete, so I stay disciplined and let the market play out without making emotional decisions. As expected, price continues moving lower and reaches our sell-side liquidity target, completing the 1-to-3 risk-to-reward setup. This trade isn't about being lucky. It's about following a clear process with patience and discipline. When you wait for confirmation and stick to your trading plan, you give yourself a much better chance of achieving consistent results over time. And that's the complete strategy. As you saw, the same step-by-step process worked on both charts. Instead of chasing every move, focus on following the rules consistently. Understand the market context. Wait for the liquidity sweep. Identify your point of interest. Wait for confirmation. And always manage your risk. Trading is a skill that improves with practice, so study this setup, test it on historical charts, and build confidence before risking real money. If you found this breakdown helpful, don't forget to like, subscribe, and let me know what strategy you'd like me to explain next.